Preparing for FP&A Analyst at REN interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does FP&A contribute to a company like REN? FP&A gives management a forward-looking view of performance and resource needs. At REN, I would connect financial analysis with electricity and gas transmission operations, regulated revenues, maintenance requirements, capital projects, and financing commitments. My role would include building budgets, updating forecasts, explaining variances, and challenging assumptions with operational teams. The value is not simply producing reports. It is helping leaders decide where to invest, how to control costs, and how results affect cash flow and regulatory objectives. While answering, focus on budgeting, forecasting, management reporting, variance analysis, capital planning, regulated infrastructure economics, and how FP&A converts operational information into decisions about investment, costs, liquidity, and performance. Question 2. How would you build an annual budget for REN? I would begin by understanding REN's strategic priorities, regulatory assumptions, and budget timetable. Then I would collect driver-based inputs from operations, engineering, human resources, procurement, treasury, and commercial teams. I would model revenue, operating expenses, personnel, maintenance, capital expenditure, depreciation, financing costs, and cash flow, separating controllable from externally driven items. After consolidating submissions, I would test assumptions, reconcile the budget to strategic targets, run sensitivities, resolve differences with owners, and document final approvals. Make sure to cover the budget calendar, operational drivers, bottom-up submissions, top-down targets, regulated revenue assumptions, personnel and maintenance costs, capital expenditure, financing, review cycles, and documented approval controls. Question 3. How do you approach forecasting when assumptions are uncertain? Uncertainty requires transparency rather than false precision. I would anchor the forecast in actual year-to-date performance, then update operational drivers such as project timing, energy volumes, inflation, personnel costs, interest rates, and regulatory decisions. I would create base, downside, and upside cases, quantify the main sensitivities, and identify early warning indicators. I would also assign ownership for each assumption and explain changes clearly, so management understands both the expected result and the risks surrounding it. In your answer, talk about driver-based forecasting, explicit assumptions, scenario analysis, probability-weighted outcomes, sensitivity testing, actuals to date, external variables, forecast ownership, and timely communication of changes. Question 4. What is the difference between a budget, forecast, and long-term plan? A budget is the approved financial and operational baseline for a specific period, usually used to allocate resources and measure performance. A forecast is a continuously updated estimate of what will actually happen, incorporating current results and revised assumptions. A long-term plan looks further ahead and connects strategy with network investment, asset development, financing, regulation, and sustainability objectives. In practice, I would use the budget for accountability, the forecast for decisions, and the plan for direction. Be sure to mention that budgets establish an approved financial baseline, forecasts update expected outcomes, and long-term plans connect strategy with multi-year investments, funding needs, regulatory developments, and value creation. Question 5. How would you analyze an unfavorable operating expense variance? I would first quantify the variance and compare it with budget, forecast, and prior year performance. Next, I would decompose it into price, volume, timing, mix, foreign exchange, accrual, and one-off effects. For example, higher maintenance expense might reflect emergency work, inflation, or costs recorded earlier than planned. I would discuss the driver with the responsible manager, verify the accounting and accruals, assess whether the impact is recurring, update the forecast, and recommend a practical response. While answering, focus on separating volume, price, timing, mix, and one-off effects, comparing actuals with budget and prior periods, validating accounting treatment, identifying root causes, and recommending corrective action. Question 6. Which KPIs would you monitor in REN's FP&A function? I would combine financial, operational, and project indicators. Financial KPIs could include revenue, EBITDA, operating expenses, free cash flow, capital expenditure, net debt, and leverage. For REN, I would also monitor regulated asset growth, project delivery against schedule and budget, maintenance spending, network availability, safety, and service reliability. The important point is linking them. A delayed project may reduce current capital spending but create future costs or regulatory consequences. I would emphasize trends, drivers, and forecast implications. In your answer, talk about revenue, EBITDA, operating cost per activity, capital expenditure, project progress, cash flow, leverage, regulated asset indicators, reliability metrics, safety, and leading versus lagging measures. Question 7. How would you forecast revenue for a regulated energy infrastructure business? I would start with the applicable regulatory framework and understand how tariffs, regulated asset bases, allowed returns, incentives, and pass-through mechanisms determine revenue. I would then incorporate expected network volumes, asset additions, decommissioning, inflation, regulatory adjustments, and timing of tariff decisions. I would reconcile the model to historical billing and regulatory disclosures, involve regulatory and operational experts, and create sensitivities for volume, inflation, interest rates, and policy changes. That approach makes the forecast transparent and commercially useful. Make sure to cover regulatory determinations, approved tariffs, regulated asset bases, allowed returns, volumes, incentives, pass-through items, timing, actual data, and scenario analysis around regulatory changes. Question 8. How would you evaluate a capital expenditure project at REN? I would first establish why the project is needed, whether for regulatory compliance, network resilience, capacity, safety, or efficiency. I would build a cash flow profile covering construction spending, commissioning timing, operating costs, savings, asset life, depreciation, financing effects, and possible regulatory recovery. I would assess NPV, IRR, payback, and scenario sensitivities, but also consider non-financial benefits and execution risk. Finally, I would define milestones and compare actual cost, timing, and benefits with the approved business case. Be sure to mention strategic and regulatory rationale, initial investment, timing, operating savings, reliability benefits, cash flows, NPV, IRR, payback, risk, delivery capacity, and post-investment monitoring. Question 9. What would you do if actual capital expenditure is below budget but project completion is delayed? I would not treat the underspend as automatically favorable. I would determine whether costs are genuinely lower or simply deferred because procurement, permitting, or construction milestones slipped. I would review commitments, revised contractor schedules, remaining contingency, and the effect on commissioning, reliability, regulatory obligations, and future cash requirements. I would update the forecast by period and in total, explain the variance as timing or scope where appropriate, and escalate any risk that the delay could increase eventual cost. While answering, focus on distinguishing favorable timing from genuine savings, checking committed costs, revising completion dates, assessing operational and regulatory consequences, updating cash flow, and communicating the full picture. Question 10. How do you build an integrated three-statement forecast? I would begin with operating drivers that produce revenue and expenses in the income statement. Capital expenditure feeds the fixed asset schedule and depreciation, while working capital assumptions connect income statement activity to cash flow and the balance sheet. Debt schedules capture borrowings, repayments, and interest. Taxes and retained earnings complete the equity movements. I would ensure cash flow reconciles to the change in cash and perform balance checks. An integrated model is stronger because every assumption has visible financial consequences. In your answer, talk about linking the income statement, balance sheet, and cash flow through operational drivers, working capital, capital expenditure, depreciation, debt, taxes, retained earnings, and balance checks. Question 11. How would rising interest rates affect REN's forecast? The impact would depend on REN's debt maturity profile, fixed and floating rate exposure, hedging arrangements, and regulatory recovery mechanisms. I would update the debt schedule using revised forward rates, identify refinancing dates, calculate interest expense and cash flow effects, and assess leverage and covenant headroom. I would also test higher rate scenarios and consider implications for project economics and funding capacity. I would coordinate with Treasury because the forecast should reflect actual risk management, not merely a theoretical market rate assumption. Make sure to cover floating versus fixed debt, refinancing dates, interest expense, cash flow, leverage, investment returns, regulated recovery mechanisms, hedging, covenant headroom, and sensitivity analysis. Question 12. Tell me about a time you improved a reporting or forecasting process. In one role, monthly reporting required manual consolidation of several departmental files, which created delays and inconsistent definitions. I mapped the process, agreed a common chart of accounts and KPI glossary with stakeholders, then built a controlled template that imported standardized data and flagged missing submissions. The reporting cycle became faster, review questions became more focused, and management received results earlier. I also documented ownership and performed reconciliations, so the improvement strengthened both efficiency and data quality. Be sure to mention the original problem, stakeholders, data sources, automation or standardization, controls, measurable improvement, adoption, and how you ensured the solution remained reliable after implementation. Question 13. How would you ensure data quality in an FP&A model? I would define the source and owner for each important data element, then reconcile imported figures to the general ledger, operational systems, and prior approved reports. I would use locked formulas, controlled input cells, validation rules, version naming, and automated checks for missing data, unusual movements, and balance inconsistencies. I would maintain an audit trail for assumption changes and obtain business owner confirmation. Good data quality is a process discipline, not something fixed only at the end. While answering, focus on source system reconciliation, controlled inputs, consistent definitions, validation checks, version control, audit trails, segregation of duties, exception reporting, and review with business owners. Question 14. How do you communicate financial results to non-finance stakeholders? I start with the business message rather than a spreadsheet detail. I would explain whether performance is ahead or behind plan, identify the operational drivers, separate recurring effects from one-offs, and show the forecast consequence. For example, I might link higher maintenance costs to specific work orders and explain whether reliability benefits justify them. I use concise visuals, define technical terms, invite the owner's perspective, and finish with decisions, actions, and accountable deadlines. In your answer, talk about leading with the message, using plain language, linking numbers to operational drivers, separating facts from assumptions, visualizing trends, inviting challenge, and ending with decisions or actions. Question 15. What would you do if an operational manager challenged your forecast? I would treat the challenge as useful information, not resistance. First, I would understand which assumption the manager disputes and review the underlying operational evidence, such as project schedules, staffing plans, procurement commitments, or maintenance requirements. I would reconcile our definitions and timing, then run an alternative case showing the financial effect. If the difference remained material, I would present both views, explain the evidence and risks, and agree an owner and trigger for revisiting the forecast. Be sure to mention listening first, clarifying assumptions, checking evidence, reconciling financial and operational views, testing alternatives, documenting ownership, and escalating only unresolved material differences. Question 16. How would you assess working capital and cash flow at REN? I would analyze working capital by linking each balance to its operational driver and payment pattern. Receivables require attention to billing, collections, and counterparties. Payables and accruals require supplier terms, project milestones, and completeness of liabilities. I would also assess inventory, construction-related balances, tax timing, and capital expenditure phasing. A rolling cash forecast would highlight liquidity needs and timing risk. I would explain movements against budget and identify actions, rather than treating working capital as a purely accounting result. Make sure to cover receivables, payables, accruals, inventory, construction balances, payment terms, collection timing, capital expenditure phasing, cash forecasting, liquidity buffers, and operational causes of movements. Question 17. How would you prepare a scenario analysis for an energy infrastructure plan? I would begin with a clearly documented base case and identify variables that could materially change outcomes, such as regulatory tariffs, inflation, interest rates, energy volumes, project delays, and construction costs. I would build internally consistent upside and downside cases rather than changing isolated numbers arbitrarily. Each scenario would show impacts on EBITDA, capital expenditure, cash flow, debt, and key ratios. I would also identify early warning triggers and mitigation actions, enabling management to respond before the downside fully materializes. While answering, focus on defining the base case, selecting material drivers, creating coherent upside and downside cases, quantifying impacts, avoiding double counting, and presenting management with triggers and mitigating actions. Question 18. What Excel or analytical tools do you use for FP&A? I use Excel for driver-based models, reconciliations, scenario analysis, and clear management schedules, including structured formulas, pivot tables, Power Query, and sensitivity tables. Where available, I use ERP data, SQL, or reporting tools to reduce manual extraction and create repeatable dashboards. I focus on transparent logic, documented assumptions, error checks, and controlled outputs. I would select technology based on the process need. Automation should reduce repetitive work while preserving reviewability and a clear audit trail. In your answer, talk about Excel modeling, Power Query, pivot tables, dashboards, SQL or ERP data, automation, documentation, controls, and choosing tools that improve speed without weakening transparency or reviewability. Question 19. How would you investigate a material difference between management reporting and statutory accounts? I would create a bridge from management reporting to statutory results and classify each difference by timing, accounting policy, scope, presentation, consolidation, or one-off item. I would check accruals, provisions, depreciation, eliminations, foreign exchange, and reclassifications against the ledger and supporting schedules. I would confirm whether management KPIs use adjusted definitions and ensure adjustments are documented and approved. If material, I would involve financial reporting and auditors early, then improve the reconciliation so the issue does not recur. Be sure to mention accounting policy differences, accruals, eliminations, reclassifications, consolidation, timing, non-recurring items, reconciliation schedules, materiality, and collaboration with financial reporting and audit teams. Question 20. Why do you want to join REN as an FP&A analyst? REN appeals to me because its infrastructure is essential to energy security and the transition toward a more sustainable system. That creates a meaningful FP&A environment. Decisions must balance regulation, reliability, long-term investment, financing, and disciplined cost management. I would bring strong analytical skills, attention to detail, and a practical communication style, while learning from operational and finance experts. I am especially motivated by turning complex data into clear decisions that support resilient networks and responsible growth. In your answer, connect REN's critical infrastructure role, regulated energy environment, long-term investment needs, analytical complexity, sustainability relevance, collaborative culture, and your own finance, modeling, communication, and learning strengths. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.